Well, good afternoon and welcome to HIROC's weekly webinar where we're going to talk about what we see happening in the global economy, in financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and normally I'm joined by my partner and colleague Paul Tepsich, the founder of HIROC, but he is out today in some important meetings, so it's just me and our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. As we do each week, let's start with a quick review of our themes for 2017. As some of you who listen regularly will know, we think that our strategy of having a tactical perspective to investing becomes even more important in 2017 because of the even greater levels of uncertainty imposed on us by a number of developing factors. If the new U.S. administration is able to push forward some of its tax proposals and spending initiatives, there is a greater likelihood of inflation, and the expectations surrounding this will change the dynamic in financial markets. And to a large degree, bond markets have already been showing this. Higher bond yields and higher short-term rates in the U.S. with 2 or 3 more Fed rate increases and the resulting upward pressure on the U.S. dollar will increase the costs of borrowing, which in turn could present us with a whole new set of risks with global debt levels at record highs. With improving economic conditions and a lower tax burden, it is expected earnings will grow at an approximate rate of 11.5% in 2017. However, this appears to be more than priced in to current equity markets at the moment. While it is wait and see on details from the White House at the moment, Brexit will likely get Article 50 invoked by the end of March and begin the process of exiting the EU. It remains to be seen how the new populist revolution plays itself out in upcoming elections in the Netherlands, France, and Germany, but it is all creating a great deal of uncertainty. We will come back to the latest developments on these shortly. So why are we placing greater emphasis on a tactical approach? Well, basically, the old rules for balance and diversification are no longer working in their traditional manner, and long-held relationships between asset classes have been breaking down. This was an important part of the development of a tactical investing model to complement our fixed income and global equity models. Well, stock market volatility has remained subdued, but the difference between the VIX and the Global Economic Policy Uncertainty Index is now at its highest level on record. So we are looking for something to give here, and hence another strong argument for being nimble and tactical. When we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Adding a more tactical approach to investing has paid off considerably over the 2-year period, as we've been showing in the last few weeks, with superior returns versus the combined benchmark portfolio of the All-Country World Index ETF and the Canadian Universe Bond Index ETF. When we compare a traditional buy and hold strategy at a competitor from April of 2014 until very recently with an actual HIROC client over the same period, which portfolio do you think you would rather have? I like this one myself. As we do on a weekly basis, we compare the weighted benchmark portfolio after allowing for fees and costs with an actual HIROC client portfolio. And although the 12-month returns look a little lighter, we are focused on longer-term performance. And in this case, from October of 2012, which has far outperformed the benchmark, which justifies our approach. And as a reminder, historical returns are no guarantee of future returns, but at HIROC, as you all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the same direction as your goals. Will inflation data remain below target on a global scale, but expectations continue to be for higher levels of inflation? At the moment, we do not see any policy changes coming at the central banks. And after 4 years of commodity price deflation, prices have actually been rising since early 2016, but have recently started to plateau. In recent data, the U.S. Federal Reserve, the U.S. Federal Reserve has a dual mandate, which, as well as price stability, also gives them the ability to strive for full employment. There is lots of debate as to what exactly that full employment level is, but the natural rate of unemployment is one that does not contribute to inflationary pressures, and that is seen currently at 4.7%. Well, this also adds to the Fed's ability to be patient on its next interest rate increase, with current unemployment at 4.8%. The U.S. employment growth actually peaked in mid-2015, and using the red 12-month moving average line, we can see that it's actually been trending a bit lower. And without wage growth, inflation is limited in its ability to progress, and wage growth appears also to have stalled. And as we monitor the longer-term implications, historically, a merging of the actual unemployment rate and the 3-year moving average has signaled a recession. And while this is not currently a part of the conversation, the fact that current unemployment rates have stalled and the 3-year moving average continues its steep decline, it really is only a matter of time. But the question is, how much time? Well, higher inflation expectations have been built into U.S. bond yields since the election, putting upward pressure on borrowing costs, especially in the longer-term maturities. And in Canada, there has been less growth in inflation, and while bond yields have tracked U.S. yields higher, they have not done so to the same degree. Longer-term, borrowing costs have risen, but without the desire for the Bank of Canada to raise interest rates anytime soon, short-term rates remain lower and likely will for some time. For borrowers, this means that staying variable remains the best option. Well, as for corporate earnings, it is expected that they should return to better growth, with energy companies rebounding considerably after big declines through 2015 and 2016. However, this is all built in to current stock market prices, which on a forward price to earnings ratio look as expensive as they were at the beginning of 2015. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. So we have to keep that in mind as well. And there is plenty of action on the geopolitical front after the course of the last week. And keeping in mind that the International Monetary Fund's latest analysis, in its latest analysis, it raised its forecast for U.S. growth based on the Trump agenda, but has warned that a protectionist trade proposal set off a trade war. It could be quite destructive for the global economy. Well, the travel ban may go to the Supreme Court to test its legitimacy. And as a recap, Citigroup issued this matrix of what is happening with the new administration's promises. I did post it on my blog this morning. For those who may be interested, feel free to go have a look. While hopeful, financial markets continue to wait for more specific details, especially on tax reform and infrastructure spending, to justify the recent upside to equity market prices. As more and more experts weigh in, the outcome is becoming a bigger debate. And while the British Parliament debates Brexit, it is expected to pass and Article 50 to be invoked, and that will begin the 2-year time limit to negotiate the UK's exit from the EU. But, as I said, 2 years, and a lot of things can happen in that period of time. Well, also, over in Europe, National Front leader Marine Le Pen will take back control of the central bank and fire up the printing presses as she leads France out of the euro if she wins the presidential election in May. Le Pen is making a return to monetary sovereignty a key plank of her policy platform as she seeks to replicate the populist victory of Donald Trump in the U.S. and has set up a task force to prepare. So here at High Rock, with all this upheaval, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research. As we did last year, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. And as we've been talking about over the last couple of weeks, we did some trades in mid-November that involved selling fixed-rate perpetual preferred shares and buying fixed-rate reset preferred shares to coincide with long-term interest rate adjustments for all of our clients simultaneously. And this is just one example of how being tactical can reduce risk and benefit return in a portfolio. And as Paul mentioned last week on the call, we of course have to keep an eye on what is happening with market correlations. Well, short and sweet this week, but as always, we want to thank you for taking time out of your busy schedules to tune in. If you do have any questions or concerns, please certainly feel free to email them to us. We will be back with our next update next Tuesday, February the 14th. But until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a wonderful week.